over the last almost 2 years of the ER task force existing, if I had to pick two topics I think we've spent most of our time on, I'd say they're probably technology and markets. And somehow we've avoided project finance up until this point, despite it being, I'd say, totally foundational to the industry. Much of what we do does not exist without project finance. And so it's really, really key to cover this topic. And luckily, over about the past half year, I've been getting to know today's guest, Julian Torres. Julian joined the company I work for, Scale Microgrid Solutions, as our Chief Investment Officer, not too long ago. And in just that short time, I've learned a ton about the topic, and specifically how it relates to DG and DERs in ways I really just hadn't considered before. Julian brings a wealth of knowledge on the topic. He's done all sorts of project finance, from DG stuff to billions of dollars of tax equity for utility scale solar and wind. So he's a really great resource for us to learn from today. And with that, Julian, maybe to kick things off, could you just tell us a little bit about yourself and your background and how you wound up in this space?
Sure, and I'll try to keep this pretty tight. I've been in the project finance and capital markets side of the business world for over 15 years, starting out my career at Credit Suisse in asset-backed securities, progressing from there to a boutique specializing in project finance and tax equity around the time the credit crisis was in its deepest point, with the corresponding stimulus bills coming out of Congress in the Obama administration. From there, built up a successful advisory practice and parlayed that to capital markets role with a Kleiner Perkins backed resi solar company called Kilowatt Financial, and took that investing in capital formation experience to RBC Capital Markets, where I helped launch their tax equity investing platform and really created a multi-asset investing platform for renewable energy, and ran that for about 5 years before joining Scale Microgrid Solutions, and where here we have the intersection between technology, capital, and business development to put a lot of different pieces to work in a very innovative, value-creating way for our customers and our owners. I have a background in finance from my starting with undergraduate training, and continued on through professional development with the CFA program, which focuses on very sort of technical and analytical approaches to the investing world that are useful in our day-to-day. Seasoned sort of industry guy, a lot of experience with different financial products and how they can be structured and used to solve problems to get assets constructed, financed, and ultimately operating at hopefully their lowest cost. So at Scale Microgrid Solutions, we're really excited to have what we call Capital Solutions, which is a platform to deliver value and tailor a financial outcome for counterparties or investors that is value adding and unique.
Awesome. I think it might be useful. I'm sure there's folks on here who are really familiar with the subject matter, but then others who aren't. Like, maybe we could zoom way out for a second and just talk about what project finance broadly is. Set a foundation here.
Yeah, I think that's a great idea, Duncan. And project finance versus just straight up trade credit or other sources of corporate finance is a little unique in that it's financing an asset or a business where there's very limited scope for creating new value within the thing. So we use special purpose vehicles to own assets, and the revenue stream to pay off the financing needed to acquire and develop and construct the asset. It's all encompassed within a framework of contracts and that create the ability for a lender or a tax equity investor to be assured they will be repaid just from that asset. So there's no follow-on, there's no initial public offering, there's no ability to go back out to raise new funds. You're not selling a new product out of this asset. The asset is the only source of repayment for the financial obligations. And that makes it a lot more efficient and safer to finance these assets. And so, it's project specific. And sometimes there are companies that develop lots of projects that might bundle them together and raise financing against that one project or that portfolio of projects versus, say, raising funds at the corporate level, where the risk profile might be very different than the underlying assets.
And maybe, when I first heard of project finance, I heard about it in the context of a large port that was being built, right? So could you give us an idea of this is a big space, and we're here to talk about DERs and DG, how much of that do we represent, if any measurable amount?
Yeah, it's a great question, and I think it's really helpful for particularly this audience to understand where they fit into the world, where we fit into the world. So the global volumes for real assets that project finance is largely geared towards is about $800 billion. About half to 2/3 of that in a given year will be in North America. So, about $400 to $300 billion. Infrastructure that's not real estate is probably about a quarter of that. So around 90 to 100, $115 billion. Power and utilities, lately, over the last last decade or so, with the transition away from aging coal infrastructure to natural gas and renewable energy, has been about half to 2/3 of non-real estate infrastructure expenditures. And renewable energy has been about half of that. So you're getting into the sort of $10 to $20 billion sort of area for transaction volume. And then within that, distributed generation is between 5 and 10. So you're really getting narrower and narrower. And when we get down to microgrids, you're in the $500 million to $2 to $3 billion range, depending on how you define a microgrid, which that could be a separate DER task force meetup, and then two, how you define whether it's been financed or how it was funded, and that this excludes the self-financing of investment. So, and that could be in the form of government expenditure or utility expenditure and that sort of thing. So these are more commercial assets in that context. So you think about the global capital markets, where the value of the stock markets is in the trillions. This is a very small asset class. Even at the deeper end on the utility scale side, it's still pretty small. And so that, I think, creates a lot of interesting features. It creates opportunities. It also means that it may not be as efficiently financed as some of the other asset classes that are out in the market.
And can you describe to us, like, I think a lot of the times when people think of project finance, they think of debt, right? Folks talk about, you raise money for your business via venture capital, and then you get debt to do other stuff. But it turns out it's more complex than that. And I think that's something folks miss a lot of the time. Can you describe what's the capital stack? What does a project financing kind of look like?
Mm-hmm.
What are its constituent parts?
Sure. There are a couple of implications by calling it a stack. So for the non-bankers out there, if you can envision like a bar chart where you've got by order of seniority, debt and tax equity, depending on structure, you can flip those, and then equity is the most subordinate piece in that bar chart. The components add up to the value of the assets. So if you have $100 million power plant, then your capital has to be worth at least $100 million to equate the two. The project financing generally does refer to the debt piece of it, but that tends to drive how you think about the tax equity, which is specific to renewable assets, and the cash equity that is following the residual value and sort of all of the requirements of those other two components of project financing that are senior to
it. And are there certain groups who are sort of providing each of the, tax equity, cash equity, debt? Like who's doing that? Do they all come at a project all at once? Does somebody have to wrangle them? Who are kind of behind those entities? Tell us a little bit about these groups.
So most of the financing, when we think about particularly the renewable markets, is provided by banks. Banks provide most of the tax equity. Banks provide most of the debt in this market. And when I say this market, those are conditions that are current today, as well as probably the last 5 or 6 years, where bank financing has been very dominant as the lowest cost. The public markets that are available for debt can include institutional investors, so think pension funds or life insurance companies, and other types of endowments that have a very long-term investing horizon and are either trying to invest to match a future liability, like an actuarial table in the context of a life co, or similarly a spending need in the future in terms of a pension plan, that has to be able to pay out benefits over time. So they're looking for ongoing cash flows with a high degree of predictability. The bank market tends to be large commercial money center banks like Wells Fargo, Bank of America, and so forth, that aggregate a lot of deposits that have a much shorter time horizon. So they tend to be very efficient on the short end of things. So construction financing that might last between 6 and 18 months, you would get from a bank. And then there's this sort of intermediate product that is taking you from a construction financing to de-risking your asset. So that tends to have a 5 to 7 year term. We call that a mini perm. And that again works well in the context of banks take lots of really cheap money, which are deposits from customers, but can turn over very, very quickly and try to lend longer. Normally there's a yield curve. So short-term rates are lower generally than long-term rates. And if you source your capital on the short end and you deploy it over the long end, you can earn the difference in the spread. So that, those are the drivers of the biggest sort of components of capital in the marketplace. Other sources of capital that line up along those lines are tax equity, largely bank finance. All the banks in the US are taxable. The endowments and institutions, some of them are exempt from taxes. So pension plans don't pay taxes. For example, life insurance companies do. Some of them can play both spaces, but there are only a few that actually provide tax equity and say invest in bonds or rated securities issued by projects. The other interesting area where the institutions play is in securitization. This is really important to distributed generation as opposed to the utility scale end. And you can take some of the attributes of project financing and apply those with even more protections and achieve credit ratings that you wouldn't normally get to. So Sunrun, for example, could issue bonds rated single A, even though they don't have the corporate profitability and capital ratios and so forth to justify a single A rating. But because of the structuring, because of the protections in place for those bondholders, they could issue asset-backed securities to insurance companies, pension plans, high-yield bond funds, and so forth that would own that paper, and then take advantage of the capital markets with that rating. And the concept there is aggregating lots and lots and lots of assets, statistical pools of assets, where no single concentration has a large impact on the outcome or performance of the pool of assets and the underlying bonds. So it leaves us to sort of the cash equity. That piece of the capital stack comes largely from private equity in today's environment. A lot of the listed companies that were popular about 5-6 years ago have merged or been taken private. We're all aware of the bankruptcy of SunEdison, but largely public ownership of projects has become less of a trend. Private equity ownership of projects has been the dominant trend, and that's provided a vehicle for the institutional market to participate in equity upside in projects. Many institutions are not able to directly invest in underlying assets. They have to have a manager in place. And that also spurs a lot of the institutional ownership of projects through a private equity vehicle.
So we had a couple questions pop up in the chat, and they seem pretty detailed. So if you think this would be better served at the end, let me know. One of them, though, is you were talking about sort of seniority within the capital stack. And Isaac over at WoodMac asked if there's a situation where tax equity would take seniority over debt.
So that's a good question, and that's actually been the dominant structure for structuring the capital stack over the last 6 or 7 years. And again, if you work back we started this conversation talking about how there's almost a waterfall, if you will, of first you start out with transactions in the infrastructure space, and then you narrow it down. As you go from wide to narrow in that funnel, you kind of like borrowing from what's the best practice for accessing the capital markets and what works best. So in the DG market, we borrow a lot from what worked really well in the wind market. What worked really well in the wind market were partnerships. There's a feature in the tax code that I'm not going to get into, but it requires the use of a partnership to monetize a production tax credit. And it turns out that the best way to finance those with debt is actually to make the debt subordinate to the tax equity, because the tax equity is largely just interested in the tax credits and depreciation. So there's been, because of that, and because of the stability of those deals, lenders got comfortable with being subordinated to tax equity. So then when solar deals grew up and became of a certain scale and meaningfulness in the capital markets 5-6 years later, starting really in sort of 2014, 2015, the markets were primed already. Okay, lenders don't really pay it or charge a material premium to be subordinate. So tax equity is what I like to call super senior in most instances. So they have like generally a structural priority over the cash flows. And even if the debt were to default, they'd be defaulting into the sponsor's equity claim rather than the tax equities claim. So that's a really great question, and it flips everything on its head that you might have otherwise thought about in terms of equity and debt.
We have a couple other here too that are interesting. Some of these I will come back to at the end because I don't want to go too far off. But very related, Ryan O'Hanlon asks, how, if you're doing DG projects, like how's this community gotten tax equity comfortable with financing DG projects relative to utility scale?
So I think that's a great question, and I like to think about DG projects and utility scale projects should all follow the same sort of tenets of what's best practice in project finance, and that means having contracted revenue streams. It means having contracted your operations and maintenance, having contracted your asset management, and budgeting for or major maintenance expenditures over the life of those assets. Also incorporating good project finance practice is making sure that your site control is fully locked down, that your site lease extends beyond the contract, at least matches your offtake contract or is longer. It helps greatly if your DG counterparty has investment grade rating. I think the DG gets a little more complicated because often you're siting the project on the premises of your host, and you are subject to not only the performance risk of your project and so forth, but also the performance risk of their underlying business. If a DG customer files for bankruptcy, then your contract is potentially at risk. You don't really have that with a utility. I think PG&E was a great recent test case of how even a sub-investment grade utility, if it does file for bankruptcy, largely those PPA contracts will be respected. So that gives the lending community, project finance community, a lot of confidence in those contracts. With the DG customer, unless they're saving a ton of money, it might be a coin toss as to whether or not the judge tosses the PPA in a bankruptcy. So it's not been as widely tested, and there are reasons why a DG contract might have some favorability. One is that relative to a straight unsecured loan, it has administrative priority. So you pay the operating expenses of a business before you pay the lenders. So it depends on the severity of the default as you're ranking DG versus utility scale. The other aspect is the development cycle for DG has a lot of different risks than utility scale profile. And I think deploying commitments in the DG space has actually been one of the big stumbling blocks for developers versus on the utility scale side of renewable energy. And that keeps a lot of people on the sidelines that would otherwise be deploying capital to a solar project of any size, for example. I think that's a great question.
Maybe something related then that I think everybody's thinking about, right? With FERC 2222, and just like kind of this future starting to emerge where DERs are, both helping their customers and helping the grid. And I know James loves this question too. From a project finance perspective, what, like merchant revenues, how do those factor in? Like, are people excited about these? Are people writing them off? Are people too enthusiastic about them? Like, what are your thoughts here on how DERs, can sort of produce these like more market non-contracted revenues, and whether or not they really kind of get integrated into, that which makes the project happen?
We've seen opportunities for monetizing ancillary services in the utility scale projects over the past couple of years before FERC 2222 came out. Like for example, in PJM, there's a tariff available for providing reactive power. Yeah, but it's not a wholesale tariff, so it's fixed over the life of the of that. So you recover it, I should say, over the life of, say, the inverter, and like that is an example where it could be an incremental stream that benefits the project finance market. It's contracted and it's fixed. And PJM is an investment grade counterparty. So that's easily monetizable. I think where the marketplace is going to struggle with some of these orders is, at this point, how are they actually implemented by the relevant authority, the RTO or the ISO? What are the rules for that? And how are those values going to be determined over the life of the useful life of the asset? Because remember, you want to have as little volatility in your cash flow stream as possible to secure the lowest cost of financing for your DG project. So if a market emerges to hedge some of those costs, or some of those revenue streams rather, then I think you'll see lenders monetizing those and giving credit to them in projects. If a market for hedging those value streams or providing a floor per se in that value stream, then I think you would see that being equity risk, as opposed to a risk or a value stream that tax equity or a lender will give you a lot of credit for. And I think the SREC market is like a very good proxy for what that might look like. And that, obviously there are different SREC markets. Some are very much like a performance-based incentive where you have very little volatility. Others are truly more of a wholesale type risk profile where you can have a lot of volatility.
And sorry, Duncan, just tacking on something to that question because you called me out. But Julian, on that point of, I think on the, I'm obviously not super informed on this, but it seems like at the utility scale level, as solar and wind have gotten more commoditized, or if you even just think of the IPP model in general, typically they're hedging out for 3-5 years, and like on the back end, there's a lot more merchant risk. Maybe, a lot of their return profile is actually dependent on forward curves for energy that you're not really, that could be 5, 10, 15 years off. Do you see that sort of moving, I guess you could say, like downstream into DG projects eventually, where DG developers will have to get more comfortable thinking like maybe an IPP, where you have 3, 5, 7 years of contracted revenues, but then there's going to be a lot more kind of merchant risk on the back end? Or is it because you're signing with kind of an off-taker on site, the customer, the whoever's building it is, that you think that long-term kind of 20-year, longer-term contracts will kind of remain indefinitely?
The trend has been, it's a good question. I think the trend has been for shorter contracts, which is not the easiest to get financed, but that has moved generally with the cost reduction. So if your payback period shortens, then the likelihood of getting a project financed with a shorter contract should adjust accordingly as well. What I typically see on the utility scale side is projects will hedge, like ERCOT's one of the biggest examples of the wholesale market being financed with third-party providers of I guess a firm contract. So either in the through a corporate virtual PPA or contract for differences, or a power commodities hedge with a trading desk. And typically we see like the hedge period lining up with the term of the debt, and that's enough to get to usually cash equity break even. So you're not, all of your profits still, even in the utility scale, all of the profit is earned on the back end with a expectation that you can take advantage of scarcity events, whether they're weather driven in the winter in extreme ways like we saw this year, or more predictably in the summer due to just demand outstripping supply. I think DG will be tougher because it tends to have a higher cost base than the utility scale to rely solely on the wholesale markets. And I think naturally there's a tendency to want to lock your customer in for a longer tenor, given how challenging it would be to remove and redeploy a C&I asset, because they tend to be a lot more bespoke than a ground mounted system, all the way down to the racking and the wiring and everything. So I think the trend will be for the more complex DG assets to continue to have longer term contracts, and for these sort of wholesale market opportunities that are evolving based on the FERC orders to provide either upside or just ways of changing how the contracts get structured. So the customer probably ends up taking a little bit more volatility around their savings or upside, but the owner of the equipment taking less risk so that they can get more efficient financing. I think that's something we'd probably end up seeing, but it's very early days.
I think that perfectly tees up Cassie's question then. She asked about just generally if you could talk about project financing for community solar. And I think that, like, thematically it's great because community solar, interestingly, right, there really are no long-term off-takers, but there's just sort of confidence that they can continuously be sourced, because unlike, say, an on-site C&I project where you have one potential customer, kind of everyone in the utilities territory is a potential customer. But what do you think about community solar? It's new and interesting and different. Are people in the project finance world kind of beginning to wrap their heads around this, feeling comfortable with it? Not quite. What are your thoughts there?
I think it's having its day in the sun, no pun intended. But the early days, Colorado and Minnesota, where you had very different flavors. I think we're talking, Cassie's question is probably more geared towards your rephrasing of that question, Duncan, is probably more about, okay, I've got the more typical model today where it's, consumers, ratepayers within, a continuous territory that can participate in a specific solar project. And, maybe there's actually room for a few hundred people to participate in a given project, but there's actually a backlog of thousands because demand far, outstrips supply at this point. The early days of community solar with Colorado and Minnesota leading the charge, with very different models. Minnesota community solar is largely mush offtakes, corporate offtakes participating, and to a lesser degree, consumers. Massachusetts was a kind of a mix between the two, but the more recent plays in DC, Maryland, New York seem to be more popular with the ratepayers. And I think with the mainstream adoption of residential solar, the financial community is very comfortable with FICO-based credit profiles, and even moving away from that with the notion that customers that are saving money on one of their larger recurring expenses are unlikely to default. And you see that we've got a lot of data now through cycles showing that the default rate with consumers on solar is very close to sort of prime mortgage default rates. So half a point per year or less. And the loss rates on those investments are even lower because of the way those contracts are structured, and you have the ability to redeploy. And it's even easier with subscriber management in community solar to ensure that that project has a high degree of subscription rate. I think there is that aspect of you just kind of have to trust that the policy framework will stay in place. I think change in law risk would be the biggest material factor there in terms of the project financing to be to remain viable. I think the market, like the financial community, tends to go where the deals are, and particularly since it's bank oriented, you've got originators in project finance groups that are looking to deploy project finance funds into projects. So as long as that that dynamic is in place, I think it's just a question of when an asset class reaches sort of mainstream and you get a few leading banks leading the way, then others will follow into the space. And we've seen that with community solar. It seems to be where a lot of the deal-making activity has been the last 6 months. Nexamp just closed a $400 million financing of community solar assets, which is really exciting. So that should demonstrate that it's kind of gone mainstream.
Are there any other asset classes, whether by technology type or like off-taker type, that are sort of new and interesting things you're starting to wrap your head around that you want to go after, or things you think could be a significant future DG project finance market?
Well, I think one trend that's emerged over the last couple of years has been for corporates to care more about their procurement of energy, to demonstrate to the market, to their shareholders and other stakeholders that they care about the environment in which they operate in and their impact on the environment. So you see a lot of people signing up for organizations and commitments like RE100, that sort of thing. Led to a lot of corporate procurement of solar. A lot of that has gone from being solely on-site in the early adopter years, the mid-aughts to sort of 5-6 years ago. And now it's kind of moved into offsite, where corporates are procuring solar from utility scale projects and settling financially to get those benefits. One thing I think they're starting to learn all too acutely is that there's still a missing unmet need in procuring solar either on-site or remotely, and that is there's no resiliency play. So I think naturally, I think that microgrids are very interesting, and in particular, multi-DER advanced microgrids, provide the most compelling outcome for customers. Customers that have solar today might not have the ability to operate in island mode, and therefore have no means of maintaining operations in a grid outage. You see that in California with PSPS. You see that in the East Coast or other storm-prone areas that might have outages to the grid. And I think the advancement of storage and dispatchable assets behind the meter and the complex and sophisticated sort of technology and equipment and software to integrate those in an efficient way is something that's emerging. Not only that, but the energy transition. So there's getting or reducing carbon footprints, adding resiliency, but then also thinking about how we use energy generally and shifting from a fossil-fired world to an electrified world, and that means more EV charging on site. And I think that's going to lead to more on-site electrical infrastructure, which leads to more needs for resiliency. So it's I think we're at the beginning of a virtuous cycle of new technology adoption. And our focus at Scale Microgrid Solutions is providing capital to advance the energy transition, because we think it's a tremendous opportunity, and we have a very compelling value-added proposition to the marketplace to finance that, to structure those service models, and deliver a very compelling product to the market.
All right, we have another really good one from the audience here. I think this is a really hairy question as well. This is from Corey, and he asked, how is increased weather volatility driven by climate change being incorporated into project finance and performance assumptions, particularly since historical weather data may not help predict the future? Has Texas changed any assumptions outside of ERCOT?
I think we're still trying to figure out what ERCOT's performance during Storm Uri is going to have on that market in itself, and broadly the effects of climate change on historical weather patterns and so forth. I can tell you that from my experience, the typical performance estimates do not take into account climate change. It's a question that I've actually been wanting to see answered, but haven't seen a credible approach or the market demand that it be taken into account today. But one would consider the impact of maybe having seasons sort of stretch out. With solar, the weather adjusted performance is a very important metric in calibration aspect of sizing any on-site generation, and it's wind is especially so with some of the different patterns that can emerge. So I think that's something that probably will evolve. Is I would imagine something that the growing risk transfer and insurance community that's addressing a lot of the needs of the community will probably start to demand, but we haven't seen it yet.
All right. Wow, they're sort of pouring in here. So another one, Joe Strawman asked, and I might paraphrase this just a little bit since it was specific to what we were talking about at the time. But I think Joe is interested in, situations where lots of small projects are being pulled together, either in some kind of portfolio, or even mentioned Sunrun and like securitizations. You want to just talk about that a little bit? It's something we haven't really touched on. Folks kind of bundling a bunch of these together and maybe producing something that feels a bit more like a larger utility scale asset.
I mean, the trouble with the DG market has been that it's been financed largely with fairly rudimentary tools. So a lot of the, like I said earlier in the conversation, a lot of the lenders and investors in the space have started and grounded their expectations and their approach and everything around investing in large central power plants. And the diligence approach has been based on that. With a large portfolio of distributed assets, your diligence approach can't be the same. It's got to be based on sampling. It's got to be based on standardization of documents. It's got to be based on the efficiency being very important, because and sort of the belief that you're unlikely to have a systemic risk flow through the whole portfolio. You'll have limited concentrations by vendor of equipment type, of limited concentrations of geographic exposure and resource, limited concentrations of credit by industry verticals and that sort of thing. And I think the resi companies have been very successful because they control that pipe and they control all the documents are the same. They control, the approved vendor lists are very standardized, but structured in a way that creates diversification. And they're in at least a dozen states, and so they've naturally got more of a macro exposure to consumer credit rather than being exposed to hospitality or being exposed to a specific retailer in a large concentration. So I think that's the promise of DG. We've only seen it actually realized with some of the larger players. It takes a lot of time and resources to get through a rating process. And to my knowledge, there have only been a few private rated DG portfolios that have been securitized, but not publicly issued. So there's very limited information available. But that's where we want to be going. That's the goal with DG, I think, is to make it a securitizable product. That's where the securitization market is very deep, hundreds of billions of dollars per year.
Interesting. All right, we have just a few minutes left. So if you do have a question, make sure to get it in. Well, James has one. So James, I'll ask you to ask that. And then I have just sort of a wrap it up question to end this with. But James, why don't you ask yours about vacancy?
Yeah, thanks, Duncan. This is something I've been exposed to recently, Julian, and in the context of like community solar and FERC 2222 and what you just mentioned on like the resi front is this idea of vacancy-based underwriting instead of credit-based underwriting. So if you have like, even if it's a behind the meter VPP for like a multifamily building with subscribers, or you could even do it kind of on a portfolio basis for single family homes. If you can kind of sell, if someone were to move out, you can still sell behind the meter power into the market based on what's coming with FERC Order 2222, I guess, although that's like, it's limited how many markets you can do that in today. So have you guys thought about, it kind of ties back in even to my earlier question on these, like the length of contracts in DG. Do you see, like, is that a trend you've seen, or have you thought much about this concept of behind the meter vacancy-based underwriting instead of credit-based, because maybe there's gonna be more access to markets for these DG projects?
Certainly for community solar and subscriber model based projects, that makes sense, where you're just assuming that you have a natural churn rate. So like 3%, 2%, whatever the number is, that's relevant. That's the assumption. And that's sort of a budgeted cost for doing business. And there are a lot of ways to probably shortcut the analysis for that, looking at retail retail market providers and seeing what their churn rates look like. Right now there's just far more demand than supply for community solar and subscriber-based projects, but that might change at some point. You can imagine a world a few decades from now where you're getting at the end of the useful life or middle of the useful life of projects, and it's now a lot more competitive. Generally, you're always going to get best execution with a long-term contract. It'll always be cheaper and less risky to have a long-term contract than a series of short-term contracts. Lenders don't really have a lot of upside, so you have to be mindful of that. That generally lenders are looking at the avoiding the downside because their returns are fixed. Equity is a balance of the two. So I think the market will finance things on what's available. So right now in renewable energy, there are a lot of long-dated fixed-price contracts out there to be financed, and those will get priority. If there aren't any, so that's the case for natural gas-fired generation is it looks a lot different. So lenders in that market have gotten accustomed, used to dealing with shorter contracts and having more refinancing risk and that sort of thing, because that's just the nature of that asset finance market.
All right, well, we've got 2 minutes here left. I want to just give you the chance to maybe tell us about something exciting happening in DERs, maybe something you're working on, a vision of the future for our space, and or any final plugs you want to make before we sign off here.
Well, I wanted to thank everyone for joining us and being part of the DER task force. I think this is a really cool thing that is driving a lot of interest in the sector. I think what's exciting is what's happening in DC right now. I think there's a lot of new policy coming out. Federal procurement is interesting. It's going to hopefully spur more or accelerate the energy transition. I think these new rules coming out of FERC are interesting and potentially beneficial to what we're trying to achieve as a business, as a sector. I touched on securitization. I think that will be a real game changer for DG. And I think DG continues to be an underserved segment. I think there's a tremendous amount of opportunity. So I'm really excited that there's just a large segment of assets that are out there that could be better utilized, better financed, that we have the skill set and tools internally to address that. And I think there are a lot of opportunities to partner with different participants in the marketplace to achieve those objectives. So really it's a very exciting time to be here. remember, I mean, when I started 10 years ago, like a big solar project, for example, was like 20 megawatts, and it costs 5 or 6 times what it does today. So the same is hopefully going to be true of a lot of these assets in DG and energy transition over that same time horizon or even shorter. So again, a lot to be very optimistic about. It's a very exciting time.
Awesome. A great note to end on. Julian, thanks for joining us.
Thank you so much.
Really cool.
Thanks, Duncan. Thanks, James. My pleasure.
All right. Thanks, everybody. And, be sure to go back to the website in a week or so. We've got some other really good meetups soon to be announced. Thanks.